time. So let's start the meeting with the roll call, please.
Pepe Finn,
Pepe is in London awaiting the birth of a grandchild.
Paul Hinkle.
Present.
Sharif Musuri,
Here.
Jody Patterson,
Here.
Captain Aaron Schaefer,
Here.
Anthony Waskowitz,
Here.
Milton Wilkins.
I happen to be here, and we now formally have to accept Pepe's explanation as to why she cannot be here, which is required by the departments.
So move.
Second,
Second.
Thank you.
done. Paul and Jody.
Did we vote?
Acclamation, I think we're good.
Sure.
We did vote?
All in
Acclamation,
favor?
Okay, all right.
considering we have no choice in the matter in any event. Okay, approval of the minutes. Everyone's had an opportunity to review them, I hope. Any comments? Suggestions, modifications? We have a motion to approve.
Motion.
Tony,
Second.
Jody, second. All in favor?
Aye.
Any opposed? Moving right along. All right, the request for benefits. As usual, we will cover the retirement requests first. There are 8 civilian requests. Anything unusual?
Did you try again?
Siri is joining us this morning. Siri may be able to put some good insight here.
He's very sassy, I find. Okay, nothing unusual about any of these or controversial.
Okay.
All right, may I have a motion to approve the 8 civilian requests?
So move.
Paul,
Second.
Jody, they're on a roll here. All those in favor?
Aye.
Any opposed? We have 6 police requests.
Make a motion to approve.
Aaron? Tony seconded.
I did.
Okay, all those in favor?
Aye.
Aye.
You can actually read my mind now on that. No, that's.
Yes,
He's amazing.
take liberties, all sorts of liberties. All right, that was approved. Applications for death benefits. For civilian, we have 4 individuals unfortunately who passed away, with 5 beneficiaries and 5 requests. Anything? Okay, may I have a motion to approve?
So moved.
Jody, move,
Second.
and Sheree, second. All those in favor?
Aye.
And we have 2 police requests.
Make a motion to approve.
Second apple.
All in favor?
Aye.
All right, now we come to the real fun part of the agenda. The gentleman from Causeway here. And obviously, you know why you're here. We know why you're here, and I'm glad to have you. You're, as I mentioned to you before the meeting, the record of the firm has been extraordinary. And so we wanted to evaluate whether we should add Causeway to our portfolio. And you are here to convince us that we should.
Well, hopefully we do. Appreciate the time. It's nice to meet everybody. My name is Colin McGeehan. I work on Causeway's business development consultant relations team out of Philadelphia. We have Steve Nguyen, who is a fundamental portfolio manager from Causeway, works out of our Los Angeles office. Very much appreciate the time. As far as agenda goes, we have about 20 minutes or so of prepared remarks. We'll leave some time for questions. But our hope is just to walk through our firm, our background, and the international value strategy. Hopefully answer any questions that you have. If everybody could please open to slide 3, I thought it would be helpful just to give some different context around our firm before Steve goes through the portfolio in more detail. So quickly expanding on what you see here, not surprisingly, our core competency is around global active equity portfolios, and that's been the case since Causeway's genesis in 2001. Though I'd point out international value, the strategy that we're speaking about today, predates Causeway's inception as it was launched back in 1990 at a predecessor firm. So over a 3-decade track record managing this portfolio with a core group of individuals who have been very instrumental in managing the strategy as well. We're majority employee owned, though I point out fully independent. So we're owned by 29 existing employees and 1 former employee who retired from the firm about 4 years ago. So no outside owners from an organizational standpoint. And as we go through our team and process, you'll get a better sense of why that's important. But we really believe that when you have senior decision makers whose interests are directly aligned with our end clients, it creates a culture of accountability. Not only that, it creates a culture of stability. So we have a couple of slides in here to talk to the tenure of our team, working with each other and sticking around with Causeway. Relatively small firm of 106 employees altogether, of which 37 are on the investment team. So we have 27 fundamental research analysts and portfolio managers who work in close conjunction with 10 quantitative professionals. And ultimately, everything we do at Causeway is built around a blend of these two disciplines. But by and large, with International Value, really what you're getting is a bottom-up, fundamentally driven portfolio managed by Steve and his colleagues on the fundamental side, who can leverage unique tools and capabilities from our quantitative colleagues throughout. We manage just about 56 billion in assets under management. You can see the breakdown listed below, with International Value as the top line item, certainly the flagship strategy of the firm. Last thing I would point out is sort of three components of our firm that clients and consultants know as well. It tends to really resonate with them. The first, again, is our independence. I think having a broad distribution of owners at 29 creates an environment, as I mentioned before, with decision makers' interests directly aligned with our clients. The second is that blend of fundamental and quantitative research. We think it creates a really powerful set of risk and reward decision-making tools for our team. And as we go through our process, you'll get a better understanding of how it works and how they interact with each other. And then lastly, we're a team through and through. There's no star portfolio manager at Causeway, and that's by design. And how we work internally is how we work externally. So when we partner with clients and consultants, we very much want to be fully transparent and accessible. So I always like to use that as a segue to ask any question you want, personal or professional, to Steve or myself. We're happy to answer. But we really want to make sure that we're not just managing expectations, but everybody understands what are the drivers of returns and what can you expect from Causeway moving forward, not just from a portfolio standpoint, but the folks you interact with on a quarter-to-quarter or biannual basis, or whatever the case might be. So with that, I'm going to hand things over to Steve to walk through the team briefly and the portfolio in more detail, and then we can open it up to some questions.
Thanks, Colin, and thank you everybody for having us here today. I was going to skip ahead to slide 9, and I really only have a few slides to talk about our process and our investing philosophy. And then if we have time, I'll touch on what the portfolio looks like, a bit on our performance and what to expect from us going forward. And feel free to jump in if you have any questions as I go along. So at the very top of slide 9, we have the 3 tenets of our investing philosophy. So I'll start with the upper left. We're a fundamental bottom-up value manager. So what we mean by that is that we approach our portfolio with just security-specific research. So we're not going in with a predetermined view. We want to have these exposures to certain sectors, or these exposures to certain regions. Everything comes through this very detailed security-specific research process that I'll share with you. And we've been doing this for the last couple of decades. And the idea is that if we're doing our company-specific research correctly, we'll get it right than we get wrong. And that's how we've delivered outperformance or alpha for our clients over time. That being said, we do think about risk. So at the middle of the top of slide 9, we think about risk in terms of overall portfolio risk or volatility. So we're okay with looking different from our benchmark. We're okay with having some level of tracking error, but we think that if we can put together the best group of individual stocks that can maximize returns while minimizing portfolio risk, that's sort of the recipe for best risk-adjusted returns. And I'll get more into how that works with our quantitative model as well. And on the upper right, Colin mentioned this, it's very much a team approach. So our clients do appreciate that we don't have a star manager system. We're not over-dependent on 1 or 2 portfolio managers. We have 8 portfolio managers on the strategy, which is purposefully top-heavy. It's probably more portfolio managers than a typical manager may have for a single strategy. But we really think this helps us maintain a consistent team process, which allows us to deliver consistent performance over time, even as over time people may change. And that being said, turnover at senior levels of the firm is quite low, as Colin mentioned, 100% employee owned. And so having the equity ownership is a great tool to keep people there, not only at the portfolio manager level where everybody is an equity owner, but many of the senior analysts are also equity owners. And so it really provides a great upside tool as people move up throughout the organization.
So you said 8 portfolio managers. Is that just for the International Value strategy, or is that across the firm covering all the strategies?
So as Colin mentioned, international value, which we're talking about today, is really the flagship strategy of the firm. And so for us in the fundamental research side, we oversee international value. The only other strategy that we're overseeing, which is really related to it, is global value, which is for the most part the same international stocks, and then we have US stocks as well.
So those 8 portfolio managers are really just international value, global value, is that
Exactly.
correct?
Yeah.
All right.
So
Not the others, not the emerging market strategy or anything else.
exactly, and I'll get to that on.
All
So
right.
I'll backtrack to slide 8. We'll talk about the way the team is organized, but that's a great segue.
Let's just try to interpret.
Yeah, no, that's.
Good.
So we really think about it as sort of 1.5 strategies that we're in charge of, international value and then global as well.
Mhm.
And so we really think of ourselves as specialists. There may be other managers where the research team is responsible for different strategies, whether it's, small cap, large cap, different, value growth, whatever. And for us, we really only think about this sort of one international value strategy. That's what we focus on. And that's the fundamental team you see in blue on page 8. We also do have this quantitative research team. I'll touch on a little bit about how they interact with the fundamental team as it relates to the risk model and portfolio construction. But also what's unique about the firm, about Causeway, is that we have other strategies where the quant team takes the lead. So emerging markets, international small cap, these are quant-led strategies. And the fundamental team will provide them with a bit of an assist as well. So there's a synergistic relationship there. Really, the heart of slide 8 is just how we organize our research team, so that the 27 fundamental research professionals that Colin mentioned, we organize ourselves into these 9 different sector teams. And so we basically have a global sector coverage model. You'll actually notice that there's some redundancy across the board. So you'll notice a lot of names that are in more than one team, and that's also by design. So as an example, you can see my last name at the top of utilities renewables. I help to oversee coverage there. I'm a member of industrial autos, where I help to oversee a portion of that. I also co-lead our efforts in healthcare. So you'll see a lot of redundancy across different sector teams where portfolio managers or analysts would be in more than one team. And we do that because on the one hand, it's nice to have some degree of specialization. I've covered utilities renewables for the past 13 years at the firm. So you build up some expertise in a certain area, but it's also really helpful to broaden beyond just, a single area. So I've had the opportunity since joining Causeway in 2012 to cover parts of consumer. I've covered energy, insurance, real estate, and then I added healthcare back in 2018. And same is true for most of the portfolio managers and analysts, is that we have the opportunity to cover different sectors. And that makes us better investors overall, if instead of just being limited to a certain silo. And also because it's a team approach to managing the portfolio, it's really important for us to have exposure to different areas. We do the bulk of our work within these sector teams, but there's also a huge emphasis to collaborate across the board. And so we want to make sure we're not siloed to our individual teams. In a lot of cases, the companies we're working on, they may span multiple sectors. And so as an example, some of the technology companies that we look at, the semiconductor companies, they're selling semiconductor components to different end markets in, say, industrials or autos or consumer segments. So they need to work with these other teams to make sure that they're seeing the whole picture. And when we present an idea for inclusion, potential inclusion in the portfolio, it's presented not only to your specific sector team, but it's presented to all 27 fundamental investment professionals. And that's a big part of our process as well. Portfolio construction is done at the portfolio manager level. So the PMs get together and meet at least once weekly. And it's in that meeting that we also collaborate with the quant team. So the quant team comes in with the risk model. We have a multi-factor risk model, similar to what maybe other managers may use on the third-party side. But what's nice to have it developed in-house for us is that if we have specific questions about what the risk model is spitting out, we can engage with our quantitative colleagues. They can get back to us and why is a certain risk factor showing up this way, or how is it broken down historically, and they can do sort of ad hoc projects for us. And in each weekly portfolio manager meeting, there is a member of a quantitative portfolio manager group that attends, and they'll relate to us any key takeaways from the risk model.
Not everybody here is an investment professional. Can you give an example of a risk-driven decision?
Yeah. I'll actually
A
get
decision which incorporated the risk modeling that you're talking about.
I'll get a lot more into that when I talk about portfolio construction, but just
That's fine.
in short, fundamental, this is really fundamental strategy. So all the stock selection, all the research is done on the fundamental side, but we think about risk and the quant risk in terms of how to put together the portfolio. And so what you want to do when you're putting together a portfolio is making sure you're not piling on more and more of the same risks. Or if you do have an increase in risk, you want to make sure that you're compensated by having a higher return. It's all about just having higher return per unit of risk. That's where our quant colleagues help us out. They can evaluate how one stock may be related to every other stock that's already in the portfolio across, they look at 120 different factors and they break it down in a lot of different ways. And so us on the fundamental side, we don't spend a lot of our time delving into these quantitative factors, since that's where it's great to have this dedicated quant team. And the fact that the quant team with this same model, they also lead quantitative strategies, it also lends a bit of credibility to their approach because they're actually delivering alpha in their own strategies using the same quant model. So I'm sorry to make you go back and forth. I'm going to flip back to page 9, talk a little bit about the research process, and then the last slide would be portfolio construction. So on slide 9, I want to spend a little bit of time about our detailed research process. And if you've ever sat through an investor manager presentation before, we all have a slide like this, an upside down pyramid. How do you dissect a universe of thousands of stocks into the more focused list of stocks that you work on? I wouldn't say that we do things that much differently, other than because we're specialists, we can really take our time and dive into the stocks that we're looking at, right? So our portfolios are relatively concentrated, 55 to 70 stocks or so in the portfolio. Even across that other strategy I was talking about, global, we only have maybe 80 stocks that we hold between those two strategies. And we have 27 investment professionals. And so we can really get to know the companies we're working on. And this is really our favorite part of the job. For me, I do enjoy doing these presentations to clients, prospective clients. I enjoy talking about portfolio construction, but my favorite part of the job is to do company-specific research, kind of geek out, listen to earnings calls, do Excel model, as sad as that may sound. So that really starts with screening and idea generation, and we're really open to new ideas from whatever source they may come from. One thing that we really pride ourselves as a research organization is that we're pretty flat. Whether you're a portfolio manager, senior analyst, or an analyst, ideas can come from anywhere. They can come from your ongoing expertise of a sector. They can come from weekly screens or monthly screens that we're looking at. The idea is to kind of filter down that overall universe into what you're going to spend more time on. And when we're doing the deep dive research on a company, that can take anywhere from a few weeks to a few months, depending on how well we know the company or how well we know the sector. And we really try to do differentiated research. As an example, in healthcare, if we're meeting with the company, we're not only meeting with the CEO or CFO, we're meeting with the head of rare disease, the head of oncology, head of R&D. We're talking to key opinion leaders and physicians and getting different perspectives from competitors. And so we just try to get different perspectives from different stakeholders in the company, put together a really comprehensive investment memo and financial model that we presented, as I mentioned, to the entire group. And the key output of that is we get a lot of feedback from our colleagues in different sectors. And even if I'm presenting a pharmaceutical company and there's a colleague of mine that's only ever covered insurance, they may not have a lot of insights into the phase 3 clinical trials of a particular drug that I'm talking about, but they may have a lot of insights into the valuation inputs I have in my model. And so that's really important feedback we get of how do my assumptions for this company compare to the assumptions other people are making for other kinds of companies. The output of this whole presentation is we compile the feedback, we make adjustments to our assumptions and our valuations. And ultimately, our price targets are validated and placed onto this rank sheet. So we have, at any given time, about 150 stocks that have gone through this whole process, have been thoroughly researched and presented. They're on this rank sheet. They have our views of the intrinsic value of these companies on a 2-year view is on the rank sheet. And that's how we can compare these different companies to each other for potential inclusion in the portfolio. And that'll be the opportunity set that we draw from for portfolio construction. So that leads us to the final process slide, which is the slide 10. How do we actually put together the portfolio? And this goes back to the team approach. So as you can imagine, the only way that we, as a portfolio manager group, every week, the 8 PMs, getting together in a room, the only way we can actually coalesce and form a portfolio is if we're following the same process. And so we have this rank sheet in hand, and we think of the rank sheet as basically the roadmap to all the information that has come through our process, both on the fundamental side, which it went through, as well as this quantitative side, which is the risk score. So we think of the rank sheet as sort of the impartial arbiter of all this information that comes through. So that when we're talking about individual stocks, at least we're all looking at the rank sheet, we all know where these stocks rank on a risk-adjusted return basis. Now, where does risk come in? As I mentioned this before, we think about risk as not only the risk of the individual stock, but also how does that stock contribute to overall portfolio risk? So that could have to do with, how related is that stock to the risks that we already have in the portfolio? If we have a lot of European financials in the portfolio and presenting an incremental European bank, then that may be more additive to risk than otherwise. And that risk score captures that. And it's not that we can't own a stock that has a higher risk, but you just need to have a higher return to offset that. We're blending the two together. We're coming up with the risk adjusted return. And I'll give you an example of where it really makes a difference. Certainly in this first example, Infineon, this is a German semiconductor company. It has a really outsized return. You can see on the right column of the blue area. So, this is going to deserve a position in the portfolio, probably regardless of the risk score. But really, it's more in the middle of the rank sheet. You have two other companies, UK Bank, Barclays, and a Swiss pharma company, Roche. Their returns are not so different, but the risk score is much different. There's a different risk contribution for that UK Bank versus the Swiss pharma company. And in that case, it allows the Swiss pharma company to compete with the UK Bank. Not that we wouldn't own Barclays, but we can also own Roche. It encourages some level of diversification of the portfolio, and it just shows on a risk-adjusted return basis, this company may look more attractive. The other really important thing about the rank sheet process is that it provides a sell discipline. That's also important as we go through the room and we talk amongst the different portfolio managers about what we want to buy and sell. If a stock has done well and there's no longer an attractive risk-adjusted return, such as this last example on the slide, Ryanair, the risk-adjusted return is going to be poor. It's going to move down to the bottom of the rank sheet, and that'll prompt the discussion to maybe we should allocate capital out of that stock into one of those stocks at the top of the rank sheet. And I want to emphasize, this is still a fundamental process, so this is not prescriptive. Nothing says you have to buy a certain amount of a certain stock that ranks a certain level, but this is all part of the roadmap that we can all follow. It puts us all on the same page. It keeps us honest with each other. That's really important when you're managing a portfolio from a team perspective.
Definitional question. This is 2025. Is fiscal year 2026 or 2027? How are you?
2 years from today, so it would be 2027.
27.
Yep.
Okay, fine. Secondly, you have 69 holdings at the moment and go up to 80. But you have a bench of about, what did you say, about 130 companies?
On the rank sheet itself, there's like 150 companies. Or so
150.
Yeah.
Why do you cut it off at 69 or 80 or whatever? What is magic about a particular number? Does it have to do with the quantitative?
Yeah, there's nothing magical
metrics?
about the number. I would say we want to make sure we have a higher weight in our conviction holdings, and so the most we'll typically have in a position, the really high conviction name would be 3 to 5% on the upper end. If you see positions in our portfolio that are smaller, say 1.5%, less than 1%, that's usually a position that's on its way in or on its way out. And so we also, as value managers, our typical sin is that we'll be too early to get into a stock, or we'll sell too early on the way up. But if we do our job right, we'll still do well while we own the stock. And so we don't try to time the bottom necessarily. If a stock is going down and there's a lot of headwinds being priced in, a lot of concerns, we may start a position and we may build a bigger position, as the stock continues to underperform. And ideally, we'll have our maximum position at the bottom, and then we'll start to take profits as the stock moves up. And so what you see at any given time, the snapshot of the 69 holdings, it's a combination of stocks that are maybe close to the full weight, and some that are on their way down, and some that are on their way up. But we don't want to set ourselves too thin, because we want to make sure that we're kind of maximizing the value of our stocks.
Mhm.
But we also want to make sure we have enough diversification in the portfolio.
What's the minimum position you'll take in?
Well, it does depend on, say, liquidity or volatility. So certain stocks where maybe they're smaller, less liquid, or they have a higher volatility profile, maybe we'll only have 50 basis points. But that would only make sense if
How many
You'd have
basis? How many basis?
50, 50.
That low?
That would only make sense if you had, maybe outsized returns from that
Mhm.
position.
Mhm.
So 50 on the low end, and then I'd say about 500 basis points on the upper end.
Okay.
So are you all based out of LA, or do you have some people elsewhere?
Yeah, the fundamental team is all in LA. The CEO, Sarah Ketter, she's actually based in Dallas, but she comes to LA every single week. So fundamental team is really all in LA. And then, we have offices in Philly for distribution.
And all your analysis, would you say most of it is in-house, or?
Yeah, it's all in-house. And so we do pride ourselves on.
And I may be getting ahead, but
Mhm.
this is showing approximately in your international value about 75% or so all European exposure. Is that still about correct?
Yeah, and on regional, I think a good way to look at it, we have another slide that shows the exposure by revenue. In front of those.
So very little exposure at this point to emerging or.
So if you look on slide 28, I think that sort of addresses it. So on the left two columns of slide 28, which show kind of what you're referring to by listing. On the very left side is our exposure, and the second column shows the benchmark exposure, right? And so we have, 45% of our portfolios in European listed stocks, ex-UK, another 33% in UK. But if you look on the right side, the right two columns, I think that's more indicative of our actual exposures, and this shows our exposure by revenue. And so there, you have companies obviously that are listed. It could be in Europe, but they may have revenue exposures elsewhere. The extreme example is we own an insurance company called Prudential PLC, not the US Prudential. It's listed in the UK. It used to have a UK business. It's spun it out. It used to have US business. It's spun it out. Now it's a pure play Asia insurer. So even though it'll show up, on the left side as a UK company,
Sure.
it's actually Asian company. That's the case for a lot of our companies. These are multinational companies with diversified revenue exposures. So you can see on the right side, our exposure to Europe is much less magnified. We do have exposure to emerging markets, and we do have exposure to, of course, North America as well.
And how closely do you track the IFA on that allocations? Is there a large variation you can do, or you pretty much track within a couple of percent?
So we're basically agnostic, and so I mentioned our process is really more bottom up. It's all company specific, and so we're okay with having different exposures either on a sector basis or regional basis versus the benchmark. Where it does come in is the risk model, right? And so if we have, say, outsized exposures to a certain area or a certain sector, that'll show up in these risk model exposures, and so that just means that for us to buy an incremental company in that area, you would need to have that much higher of a return to compensate for that risk. So at times you can get there, and I think currently we probably have more UK listed exposure than we've had historically. It has to do with UK stocks, in particular, being cheaper than they've been historically. Same for on a sector basis. At some point post-COVID, we had a big overweight to banks because banks were just really cheap relative to where they were historically. And our risk model allowed that because we saw outsized returns. But then as they outperformed, then they moved down the rank sheet pretty quickly. And so again, the rank sheet prompted us to take profits and move into other areas.
And what is the median market cap for your portfolio?
Yep, we have that on slide 11. And that's actually where I was going to go next. Just some characteristics of the fund on the bottom of 11. The 69 holdings average market cap is just below 70 billion.
Is that the average or the median?
This is the weighted average. Sorry,
Weighted
we don't have the
average,
median.
Okay.
We also look here, this is some valuation characteristics just as a headline basis. So forward price to earnings multiple here just below 11 times, which is a good discount to that broader IFA benchmark, which is around 13.5 times. There's also, for reference here, the IFA value benchmark, which is a little bit below where we are. But also what we like to look at here at the bottom is return on equity. And this is a trailing number, but you can see that our portfolio has a higher ROE than both benchmarks. And so we're able to find companies that are attractively valued, but also have attractive return characteristics. So sort of higher quality companies at attractive valuations.
So if we did put a lot of this together on performance expectations, so certainly we need, looking at you guys, a potential complement to what else is in the portfolio. So, and I know you'll hit on your trailing performance, but when you do that, can you talk a little bit about what expectations we should have of certain types of markets? Your strategies tend to perform very well, particularly relative to the IFA index, right? We all have a benchmark, right? And so what type of, tracking error expectations over time you should expect to perform?
Absolutely. So, yeah, I think maybe slide 12 is a good place to start on performance, and I'll talk about expectations as well. So on slide 12, one thing we'll look at on the bottom two lines, you have the IFA benchmark, which is kind of broad developed markets, and then you have IFA value. And value had been out of favor for quite some time heading basically into COVID. And I'll talk about how we performed in different periods when value is underperforming and outperforming. Recently, value has been doing well. So value's done well. It did well actually in 2022 when it was a down year on an absolute basis, and value held up better than kind of core growth. And then the last couple of years, 2023 and 2024, were positive years, and value also outperformed. So far in 2025, value is also outperforming. And when value is doing well, of course, that should be a tailwind for us as a value manager. So that's held up. You can see that in the 1-year performance for us on page 12, as well as 3-year and 5-year. Our performance has been strong versus the core IFA index, but also on a 3-year and 5-year basis, also versus the value index. But then there's periods of time when value is doing less well, and in those periods of time, we would generally expect to maybe suffer a bit of that headwind versus that core index, but then we should do better than value. And we actually have a slide on that on page 39. And again, sorry to make you all the way through the deck here, but on this page here, we compiled returns since inception of the strategy, which was back in 2001. And so on the left side here is when value is doing well, when value is in favor, and that's when you really expect an active value manager to deliver for you. And so that's what you see in dark blue, is that we've delivered excess returns versus the core index when value is doing well. Even though at those times you can see in orange, we may lag the value index, because sometimes when value is really ripping, then it's the lowest quality value companies that are doing the best, and maybe those companies that have weaker balance sheets or really the most bombed out. And so we don't necessarily chase those companies, and so we may underperform in times of extreme value outperformance, but broadly we're going to capture that value outperformance. I think what's also important is that in the middle of the slide here, when value is out of favor, and this was the case for like a decade heading into COVID, value had been out of favor. And in that period, you may see a headwind. You can see in blue the headwind versus the core index, but you can see that we've delivered outperformance versus the value index. And that again goes back to the kind of value companies we're looking at. We work hard to avoid value traps. We work hard to avoid companies that don't have the balance sheets to make it through a multi-year structuring period. And so if you put all those together on the right side, since inception of the strategy or of the fund, we've been able to outperform both the core index as well as the value index. And so that's what we would hope to deliver over time going forward.
How much active, put it a different way, what percentage of your holdings are actually in the ETHA value index?
Sort of like active share.
Active share is what I meant. I didn't want to use that jargon, but
Yeah.
it's your active
It's
share.
not listed, but we can certainly look that up for you.
I mean, is it typical there 90% of your holdings are going to be in the value index? Or in other words, we just want to
Yeah.
understand. Is this really truly a large cap value portfolio?
Yeah.
Or is there so much active share that it really falls outside of that definition, that very broad definition?
We could probably get back
And
to
you-
the actual numbers, so I don't want to misquote your
Yeah.
number, but vast majority of our holdings will be in the value index. But I think what's also important is that you don't want to blindly follow the value index.
Matter of fact, active share is fine with me as long as it meets the criteria that one would apply.
Yeah.
Or would define large cap value.
Yeah.
As long as it meets that broad criteria, active share is fine with me.
Yeah, and I think it does. And I think going back to that characteristics slide, if you look at us over to, this is a single snapshot, so on page 11, currently you can see we're much closer to, I'm looking at the forward PE ratio, same is true for price to book. We're much closer to the value index in terms of valuation characteristics than we are versus the core index.
Mhm.
That's a snapshot in time today, but actually if you were to look at that over time, that would be the case. We're typically somewhere between the two, but we're usually much closer to value.
Mhm.
The reason people might ask, why aren't you the same as value or even cheaper than value? And the reason being is that the value index itself is very skewed. And I could bore you with another hour presentation on how MSCI puts together the value index, but they're very skewed to certain sectors. About half of the value index is in financials, energy, and consumer discretionary. And so there are times where you want to own a lot of financials, but at least at this point in time, very late in the cycle, a lot of economic uncertainty, we've actually been reducing our position in European banks and financials. They've done quite well for us, but we don't think it's the time to load your portfolio up with those exposures. And if you wanted to replicate the value index today, that's what you would do. You'd have a lot of financials, you have a lot of energy and other areas that are a little more cyclical. So actually today, from a mix perspective, our portfolio is probably a little bit more defensive than the value index. That would serve us well if we get more economic dislocations and uncertainty. But also it's going to penalize us a little bit on these value characteristics.
And you do have some emerging market security exposure that's out of benchmark.
We do. It's a very limited amount. You can see on page 17 on the upper right there, it's a little bit less than 6% today. The vast majority of that is actually just in South Korea, where stocks like Samsung, which we consider those to be more really multinational companies as opposed to South Korea.
And that's a function of bottom up. You like the company, not
Exactly.
And 15% is the limit for emerging market exposure.
Could you repeat that, please?
15% is the limit for emerging market exposure.
And what has your average EM exposure been, if you know?
Not so far from where it is today.
Yeah.
I think, before COVID, we would have owned a little more directly in China, companies like China Mobile and Baidu, and we really haven't done a whole lot directly in China recently due to obvious macro concerns and geopolitical concerns. So it really just ebbs and flows with the opportunity set.
There are not many details on the portfolio here that I can see, but I'm assuming you are not doing any currency overlays.
No currency hedging. I would say the way to look at the portfolio, we think of it more on a sector basis than on a regional basis, for reasons we discussed. But on page 15, it gives you a little bit of flavor about the overweight and underweight exposures to various industries. I'd say right now it looks pretty diversified. You don't see really any outsized overweights or underweights. On the overweight side, and again, this is more of output as an input. Don't think about this to construct the portfolio, but this is how it shakes out. We are overweight a handful of more cyclical areas like some technology industries, but we also have some overweights to more defensive areas like food, beverage, tobacco, household personal products. And you can see on the bottom there, we're underweight areas like autos. I mentioned autos as a big component of the value index. They look very cheap, 5 times earnings, but we think it's really not the right time to invest in auto manufacturers, even outside of the tariff concerns. You have pricing concerns, prices come down, consumers are a bit weak, and a lot of capital investment needs as well for the space.
And the reason you haven't done, you don't do currency overlays is you feel you don't have the in-house talent there, or it's just part of your charter not to do it, or you'll never do it? What is the?
I wouldn't say we'd never do it, but we really typically haven't. I think our specialty is security selection and stock selection. Currency, of course, is a part of the analysis, and so especially
It's going to be a huge part of attribution. So
yeah.
I mean, if you're not doing it, it could be more critical than your stock selection.
Well, actually, historically, I think the bulk of our attribution has been more on the security selection side, and that tends to balance out the currency side. Either positive or negative. Say take Japan. We weren't really focused on, say, narrowing our underweight to Japan. We've been underweight Japan, and so when the Japanese market went on a tear, that hurt us from a country selection standpoint. And then since the currency also appreciated, that benefited us from a currency standpoint. But really, what overwhelmed that was what stocks did we actually own, and so. That because it's a relatively concentrated portfolio, it ends up really just being security selection, the big weights in the portfolio. We do have a list of the bigger weights on page 21. These are our conviction holdings. Whether or not these companies start to deliver versus our investment theses and our price targets, that's going to dictate the performance of the portfolio in the next couple of years.
I mean, actually, your attribution shows 0.2 total for stock selection.
Yeah, this is actually just for
and currency actually shows a negative 0.88 for the attribution on the currencies there. So that's extremely significant, actually.
This is unusual, I would say. I noticed this is on a year to date. So this is through 4 months of the year. Typically, when I look at this on a full year basis, and of course it varies from year to year, but typically if I look at recent annual performance, it's actually been much more on the stock selection side. And usually either you see currency and country balance each other out, or in aggregate, they don't end up being that material. But that's a good observation for this period. That ends up being much bigger than security selection. I know we're short of our allotted time for one.
Continue whatever you think is critical for us to understand. Continue.
Maybe I'll just leave you with one slide here.
It doesn't have to be just one. I want you to tell us what we really need to know.
On page 33, I think a big theme for us right now is shareholder returns. But even though I mentioned, value has been working very well for us recently, there have been times when value has not been working, but oftentimes people would ask, well, what's the catalyst for value stocks to start to deliver? And for us, the catalyst has been companies allocating capital correctly. So if a company is generating capital, generating cash, what are they doing with that cash? Are they allocating towards value destructive acquisitions? Are they investing it internally, but not in the right things? Or are they giving it back to shareholders? And increasingly, especially European companies, but also international companies are giving more back to shareholders. And so that's what we're showing here on page 33. And this is also sort of the case for international stocks versus US stocks. So on the right side of 33, you can see that this is the total payout yield for US companies. In the dark blue, you have buyback yield, which is how much stock are they repurchasing. In light blue, you have dividend yields. And so US companies had been a lot more aggressive on buybacks after the financial crisis. But the rest of the world has basically caught up. You can see Japan is close to the US, Europe is close to the US, UK is actually ahead of the US in terms of buyback yields. And then the rest of the world has typically paid a higher dividend as well versus the US. And so what you're seeing now, especially in certain sectors like banks, is that as international companies are taking some of their excess profits and returning it more to shareholders, especially if they're buying back their own shares at attractive valuations, then that is driving the stocks up. And so that's been the catalyst historically for value stocks to outperform. We see this continuing as well. We've seen an attractive valuation proposition for international stocks, especially from this shareholder return perspective. And we think that's what's going to continue to drive, hopefully, performance of international market stocks relative to US stocks.
Why is the total yield in the UK as high as it is?
Well, it's a combination of the outsized dividend yield as well as buybacks.
Yeah, I know.
And
Why? Why? What?
Yeah.
As opposed to Germany, as opposed to Italy, as opposed to.
I think there are certain UK stocks that you could argue are over distributing and paying, maybe outsized dividends that, perhaps aren't as sustainable. But I think also, obviously, the other function of that is the share prices, and UK stocks we think are particularly cheap, which is why we have a higher concentration of UK stocks in the portfolio today than we have had historically. Some of that has to do with, take the UK relative to the rest of Europe, still hasn't really fully recovered from Brexit. And so the UK economy is on a little weaker footing than the rest of Europe. So some of that concern is priced into the market. And just I think it's also the composition of the kinds of companies in the UK. They're kind of caught in the middle there. I would say US is probably on maybe the weakest footing in terms of where inflation is relative to where the central bank can go. And then Europe is at a point where, they're lowering rates and maybe that can actually be incrementally helpful. But UK is kind of stuck in the middle there as well, as where, they have some lingering inflation. So maybe there's only so much they can do on the government side to help them. I think that's kind of all I wanted to highlight. I mean, there's a lot more we could go through here. If you have any other specific questions, if you want to walk through specific stock examples, I'm happy to do that. But otherwise, I think this was basically what we wanted to get through.
Are there portfolio details that you're going to distribute separately, or you have that you can share, or
This specifically what sort of
your holdings,
So we do list our top 10 holdings, and then we list the increases and decreases. The portfolio activity is listed.
where is that?
Yeah,
I missed it.
So it's slide 19.
21 has the top 10 holdings, but actually, if you look at page 19, you'll see a lot of stocks listed there that are significant contributors to, this is just year-to-date performance, but both contributors and detractors year-to-date. And then on page 20.
I saw that, okay.
Page 20, you'll see companies that we've added or sold or reduced also year-to-date. So again, it's only year-to-date, but you'll see a lot of the companies on there. We also have a handful of case study slides beginning on slide 23. And if you're interested, maybe I'll just take you through one of them really quickly. On slide 23, this is one of our top holdings. This is a company called Kering Group, which is the owner of Gucci. And this is actually an example
No,
of,
well, yes.
this is
It's
not,
come down, it's come down a lot.
yes, this
So
is
is it
not,
trading at 20% or 30% of its high right now?
yeah,
Something like that?
much less than that. Yeah.
Yeah.
So this is not a success story for us as of yet, but this is sort of part of the playbook is that we entered into the stock 2 years ago and we anticipated that there could be further weakness and we wanted to build a position gradually as it went down. And full disclosure, it's taken longer to turn around than we expected. It was suffering from basically 3 headwinds. So there's kind of been a broad downturn across luxury in different markets. Obviously, China is a big driver for this company and for other luxury companies, about a third of their sales. And China has been also weak for years. And then specific to Kering is Gucci, which is about half their sales. Gucci was in the midst of a turnaround. They had a big uptick in sales post-COVID, and sales have been declining. So they faced these 3 headwinds. And what we're investing in was the turnaround, the eventual turnaround, some of which was under their own control. And
So a global slowdown recession is not in your playbook, I take it.
well, so the way we approach that, and I wouldn't shy away from the fact that any company we're invested in has some degree of cyclicality or some degree of exposure to, external factors we can't control. And also, we don't profess to be, experts in macro forecasting, and we can't say we've gotten it right every single year. But what we do like to invest in is stocks where they're already reflecting macro headwinds. And so, say heading into 2025, potential macro headwinds coming from a lot of this turmoil macro-wise maybe caught a lot of stocks off guard. For Kering had already been so beaten down by basically a recession in their own business in the last couple of years before this that this was already priced in our view, into the stock. And so I think what's more important is the self-help going forward. And on the left side, what we're showing here is that at the current level of Gucci sales, which is about 8 billion euros, historically, these other blue dots represent other points in time for Gucci sales. They've had margins that are 30 or 35%. Today, they're close to 20%. And so they are under earning for their current level of sales. That's because they had higher costs when they were investing based on higher sales. So they can take those costs out. They have a new CEO that's come in late last year, so against the self-help. So even if they don't improve their sales, they can improve their margins just on the current sales base. So that's on the left side. On the right side, it's like, well, what's pricing the stock itself? So valuation. In the blue, you can see that its valuation relative to the sales level has declined. And for reference, its peers is kind of stabilized. And so the market is not expecting necessarily that its sales will recover. So part of our thesis is that their sales ultimately are bottoming and will start to recover. Also, we expect the P&L to recover, so margins will improve. And then on top of that, we expect the valuation to improve. And that's sort of the holy grail of a value stock. If all those things play out, is that you'll get top line improvement, you'll get operating leverage, and so you get bottom line improvement, profit improvement, and then the valuation multiple the market ascribes on top of that will also improve. We've seen that play out for other stocks where we've been successful. Has not played out yet for Kering, but that's why we had it on the slide. Is this is what we're hoping for, what we're expecting in our investment thesis in the next couple of years.
What has been your portfolio return calendar year to date through April?
I think that's on here.
I know it's in here someplace, I just can't find it.
That's on slide 12. So year to date, up 12.3%. That was through April. Things, a lot of things have changed since then as well. I think today we're closer
It
to
was closer to 17.5
Yeah.
as of yesterday.
17.5 as of yesterday.
Yeah.
But through April, how much was it?
12.3.
Okay, and Keurig was only a detractor of 70 basis points of that return.
Yeah.
And currency would be attributing what, a third of that more?
On a year to date basis, well, we have that's the numbers you saw over here.
Yeah, but I would point out, so the slide that we referenced towards the end, the average outperformance over the full cycle of 1.9%, we've actually disaggregated what's been the driver of those returns going back to 2001. 70% of it has been from stock selection, 30% from style exposure, value exposure. The impact of currency has been de minimis in the long run. So to Steve's point, there will be environments where you see a spike, maybe quarter by quarter.
But we're entering
year.
kind of a different environment.
But in the long run, with exposure to 29 different countries, it's not a massive impact on the portfolio. And then, kind of.
But you're
one of the
talking
large
about a
reasons-
couple of decades where that has been a very stable, we haven't had
There's
the
been
volatility.
Yeah, in 2013 years of
Temporarily.
crisis during COVID, there's been environments in market sell-offs where you have seen sways in currency.
Yeah, the broad trend in the last couple of decades has been more of a headwind as an international manager, obviously. And so far this year, obviously, there's been a sharp snapback, and it's been a tailwind. I think the way we'd approach it is that it's for a dollar investor is that it's a good entry point probably to invest in international stocks, but we're certainly not banking on further upside from currencies from here. We really think it's just driven by, it's really more just the valuation differential. That's, I didn't get into the whole kind of the case for international value, and I don't want to put for you with that as well. But we have a lot of slides on that, especially on slide 29.
The last X number of years, the currency has been a headwind. You mean local currency versus the US dollar, the dollar being strong. Is that what you're talking about?
Yeah.
We just have to, it's going to be interesting to see how strong the dollar is over the next 3 years.
Exactly. But I think also just, on top of that, on page 29, it shows the real headwind in terms of international stocks versus US stocks has been valuations, in that the US market has gotten more expensive and international markets have not.
Mhm.
And that's what we've been going up against on page 29. And this is going all the way back into the 70s. And we had actually touched 3 standard deviations of that US premium versus international stocks. And so this big sharp reversal you saw this year, that has pulled us back from the 3 standard deviation mark, but we're still above the 2 standard deviation mark, which is where we were, post-COVID, post the financial crisis, and post the TMT bubble back in 2000. So we still think that we're at levels that are sort of generational dislocations in terms of the valuation between US and international, even after the move we've had so far.
Just on that currency attribution, that's on a relative basis, right? Relative to the benchmark over time that you could invest in fast.
Yeah, so that's a good point. There's been a lot of headwinds for international stocks over the past, at least 20 years or so, and some of that's reflected as well in this. But I think a lot of it also is just how outstretched have US valuations got. And this is the last one on page 31. Here we're showing US versus Europe specifically. And on the top here, you can see that this is performance, US sort of threefold performance versus Europe on the top. But on the bottom, we're trying to show, how much of that came from valuations. So we're just looking at the premium of US PE multiples versus Europe. And you can see that the bulk of that's really come from valuation premiums that went from a 2 times premium, back through 2017, and now it's a 14 times premium. And a lot of that increase has come since COVID. And so, while most people would assume that the reason why the US is outperformed is because US stocks those have higher growth profiles and they're growing earnings faster. We would argue that a lot of the outperformances just come from US stocks getting that much more expensive relative to European stocks.
So if I asked you, what are your major three themes, so as to say, going forward, that you guys are focusing on from what you see, what would they be?
Oh, you meant from a sector basis?
Sector basis, whatever basis, what are the three major themes that you think you're investing?
Oh, yeah. Well, I think the one theme would probably be the shareholder returns that I mentioned, and that's
It's like in the order of the most important and then.
Yeah. I think that's probably most important for me, especially as you're heading into some level of macro uncertainty. You want companies to be in control of their own destiny, and if they're allocating capital correctly and directing capital back to shareholders, especially if their shares are undervalued, I think that's important. I think management quality is the other really important theme. And again, in times of turbulence and volatility and uncertainty, you can really tell the difference between companies that have strong management teams that are communicating well to the market, but are also taking steps not only to allocate capital, but also steps within their own businesses to outperform. You can really separate the outperformers and the underperformers when you have this level of volatility. And then I think, obviously we have all these different sort of high level themes, whether it's AI, whether within healthcare, the big theme right now is, what's going to happen with drug pricing. There's geopolitical turmoil, tariffs, all this back and forth. For us, I would say that boils down to volatility. Historically, volatility has been very good for Causeway because that creates opportunities. And so, at Active Manager, it's all about closing the gap between market value and intrinsic value. And we like to see inefficient markets because that means that there's more of these gaps. And so post-COVID, we saw a lot of those opportunities rise because there was so much uncertainty and nobody knew what was going to happen to a lot of these companies. We've seen more of that, with say Russia, Ukraine, more of that, with turbulence going on in China, and now more of this again with global macro trade uncertainties. And so we actually look forward to these kinds of environments. We see more opportunities arise, and that's where we tend to do the best historically in periods of higher volatility.
Much as I'd like to continue, we are going to have to close it off. Is there anything else you'd like to say before we?
Appreciate all the feedback, all the engagement, and the opportunity to have us share our process with you today.
Any other questions before we go, Tom? Joey?
No.
Okay,
Great.
gentlemen, thank you so much.
I really appreciate the time.
Thank you.
Thank you.
Thank you.
Very good. Sneak out here.
Thank you, guys.
Really appreciate everybody's time. Thank you.
Started.
Why did we move it back?
Some other reasons.
Fine.
If you want to go back to the minute, it's fine. It's like
It's
this.
fine with me. I wake up early.
There was one particular meeting where it was impossible for us really to start at 9:30 for practical reasons. And then we said, okay, start at 9 o'clock. And then moved to 9:30 and somehow that got baked in. We can move back to 9 o'clock if
I thought there was, maybe, you might want to just run it by Becky. I thought there
Yeah, let me-
was some issue with some people being able to come at 9. And I don't remember who.
I would prefer 9,
Okay.
but that's not a big deal. Make it work.
Okay, I'll take this up with Becky later on, possibly moving the meetings back to 9 o'clock because we need the time.
Mhm.
Okay, fine. Anything you want to say, anyone want to say about the Causeway? And the real question is, 2 questions. Number one, should we have a companion with Silchester for international nominally large value allocation? Second, should that companion, if we should have a companion, should that companion be active or passive? Sharik is particularly interested in the passive approach. Thirdly, if active, is this the active manager we would want to select for the portfolio to be the companion to Silchester? Those are the 3 questions. Anyone have any comment? Any answers?
I don't have any answers at all, but just an observation,
Please.
just looking at the, like the 10-year returns from the Causeway presentation, their 10-year return is above the passive benchmark. However, the pattern of returns is interesting, is in that 10 years, just looking at this chart, 6 of those 10, they've underperformed the benchmark. So in the years they outperform, they really outperform, but they spend most of the time underperforming the benchmark.
Do they really underperform?
Well, at least on a calendar year basis, they're trailing the benchmark, so yeah. But on a full cycle, they've outperformed. So all I'm saying is that if we prefer active versus passive, I think that's a very prudent decision. We just have to know that we're going to be looking at performance charts and looking at periods of time where they're underperforming the passive benchmark. But when they outperform, they really outperform.
When they underperform, is the underperformance dramatic?
It's a mix, I'm just eyeballing that.
Sometimes you underperform, you're perform by a small amount, you're underperform by a large amount.
Yeah. The outperformance years are really, really strong.
Well, you asked a lot of questions there, and it certainly opened up the group. There are a few pages we have that I get to just some. I won't go through all of it, but maybe to highlight a few to put some perspective. Would that help?
Yeah.
Or not, or we can start with the discussion. It's up to you.
Cool.
Well, maybe, so you guys have the blue books in front of you. It's the first tab, page number 8.
When you say the blue books, which?
I'm sorry, my ACG is actually white on the front, blue on the back. Slide 8, yes. And again, we've
What's
done
what section, what page?
tab 1, page 8,
Performance returns.
performance return.
Yeah.
Okay.
This is through 331. And again, I think we've shown this in the past, but the blue is Silchester. These are all net of fees. The green is if we were to split it, right? We talked about this, a companion, half Silchester, half Causeway. Yellow or gold is Causeway, and this purple is the benchmark. And so you can kind of see across the way, first and foremost, Silchester's performance versus Causeway has been quite a bit different over the more recent time period, particularly the 1 year, the 3 year. You can see even with that underperformance by Silchester, 3 years and longer, they are ahead of the benchmark net of fees. And obviously this 50-50 green line falls in between. Well, you can see just relative to Causeway versus Silchester, the most recent 5 years, Causeway's really dominated relative performance-wise versus Silchester. If you look longer term, 10, it's closer, and then 15 and 20, Silchester's ahead. You can see page 9 is the individual calendar years for the last 20, and we put them in order and rank. Top is the top performer, bottom of the row is the worst performer, again, of Silchester by itself in blue, Causeway in gold, and then the green is the 50-50. Again, these are all net of fees. I think the most interesting way to look at this is the next page.
Just go back to that too. It's staying on page
When you
9.
say the next page, which page are you referring to?
Well, I would say 10, but the
I
first
just want
time.
to make a comment on page 9,
Okay,
because it's all, you got to be careful of the point in time you're evaluating.
sure.
Because you hired Silchester, and at the time, we liked Silchester and Causeway. We showed both of them to you. We thought they were both good complements to WCM and Blair and Acadian that you had. But if you hired Silchester in 2023, if you look back the prior 8 years, Silchester, almost on page 9, outperformed in 6 of the prior 8 years. And so it's
Outperform Causeway.
Causeway in 6 of the 8 years and outperformed the 50-50 net. And so their performance is really good. They do a little bit better in down markets. They're going to protect a little bit more in down markets. Causeway has captured a little bit more of the upside. And so more recently, since you hired Silchester, Causeway has looked a little bit better. Not that Silchester is doing anything different or is bad. Their approach is a little bit different. So they do complement one another.
Doesn't Causeway have a higher, larger weighted average market cap?
Yes.
As I recall, Silchester really has a lot of exposure to mid cap, whereas Causeway is more disproportionately exposed to large cap, which is what we're paying them for, actually.
Yeah. And then just to, so that page 10, again, to Jake's point here at the end about just, we like both managers, Silchester and Causeway. Certainly, we interviewed, or we talked to both, and the decision was down to both a couple years ago, it chose Silchester. But on this point of when one tends to perform better or worse in different types of markets, so page 10 is the same last 20 years, but instead of chronologically, it's by what the returns were in the marketplace. So in periods where returns would have been negative, you can see that's the top group. Silchester performed better than Causeway in all 6 of those years. In the periods where returns are somewhat in the middle, right? If a blend of the two was up between 0 and 15, it's kind of split. There's 7 years there, Silchester's ahead 4, Causeway's ahead 3. But it's in those really big up periods where Causeways tend to perform better relative to Silchester. So again, this idea of complementary and how they might certainly complement each other but perform differently, thought this is a good way to look at it.
And to Milt's question about market cap, you see that on page 13. So you see the EV value on the left.
Yep.
This is as of the end of March. Silchester is going to consistently be more in the small to mid cap space.
Yep.
And Causeway higher up. Now, the other thing that this is not including is the growth side, because we are collectively implementing your non-US equity with growth and value. This is just the value. So WCM on the growth side is going to consistently be more larger cap.
Yeah.
Because growth managers are just going to have bigger companies in their portfolio. But you see from a sizing standpoint, these two managers they're doing some different things on the value side.
Well, if you, what do we have here? Causeway. Are those additive? No, 15 to $50 billion is 37% allocation, whereas Silchester's 25. Causeway on the 7.5 to 15 billion. Causeway is 10 billion, and Silchester's 14, or 10%, and Silchester's 14. So what I'm looking at as the size complementarity of the two, they are not the same thing. You're not buying the same animal twice. You're buying something different. You're buying a diversification of focus and possibly investment style, or investment process within the same asset class being large cap value.
What we were
And
trying
it's
to do,
arguable whether Silchester is really large cap or large mid.
they're an all cap strategy.
Yeah.
And when,
Yeah.
And so we're not, again, if we were to do this, in my judgment, we're not buying the same thing twice.
That's fair. Yeah, we agree.
That's why I'm looking for the complementarity.
Well, it looks like we're gonna experience a lot of volatility with Causeway as well as the other. And 50-50 seems to stabilize the returns because, just like you said, they're really not the same thing. They're similar depending on what attributes you're looking at. But obviously, they perform differently in different types of markets. And so I think it looks like from these several slides we just looked at, they really are complementary. And it's going to significantly reduce the volatility that we're going to see. Or at least that's been my take on this.
I agree with you. Any other observation? All right, does anyone want to argue specifically for a passive approach to this? You were interested in that.
It's not so much that I'm interested in a passive approach, you know, I think everybody knows here that I've been pounding the table on the fact that US valuations are a little bit out of hand and the dollar is going to weaken, which we are now seeing. And also the fact that the international values are much better than the US valuations. With that backdrop, I don't think Causeway executes what you're looking for multiple reasons. Number one, they don't have the bench to deal with if we have the global volatility, if we have these changes that are going to take place, they don't have the bench to deal with it. Number two, and that you can see through the numbers. I mean, it's underwhelming. Whatever you look at here in the portfolio of Causeway, I think it's underwhelming. I think you can execute this much better through a passive approach or another active manager. But there is nothing that I saw here that was impressive.
Do you guys have a reaction to it?
I'm not sure what you mean by the bench to deal with what.
They don't have the global presence. They have a small team in LA. You have much better companies, whether it's Templeton, Franklin, whoever, the big names or whatever, that you can achieve much better, I believe, exposure with people on the ground who know what's going on. Number two, you are exposing yourself mainly to Europe here, which you're going from one currency issue of the dollar to another currency issue, which is possibly a bigger problem. And I don't see how that helps us. You're 70% or whatever Europe now. So I mean, that's whether the companies do business in other countries, so do American companies do business in other countries. That's not how to get the exposure from multinationals.
I would just, it would be a portion of your non-US equity portfolio. If you go
I
back
understand.
to page 5, and so.
I understand. I don't understand. I mean, I like I said, I don't see anything here that is jumping out at me. And I mean, I'm the biggest proponent to going international, probably on this table, but this manager is doing nothing.
And that's a different discussion. You've already made that decision to increase your
Right.
equity relative to US. So there's a little bit more capital to be reallocated there. This is just how we implement within non-US equity. And I do think it's not just.
How we implement within non-US large cap equity.
And I would say it's the whole thing, because if you remember when Silchester the decision on Silchester was as a complement to WCM and Blair, it was a replacement for both Sanderson and Mondrian, as you'll recall. Mondrian was small cap and Sanderson was more larger cap focused. And to utilize a single manager that was more all cap allowed us to get rid of both of those managers. Clearly, as we look at just construction and historical return patterns on the value side, Silchester is going to consistently be more in the small to mid than capture some of the upper end. So we're Causeway is a high conviction manager for us. For our firm, we use them as a complement to these strategies in a number of ways. As far as currency goes, knowledge, they're not, and none of your managers are currently trying to hedge out currencies, because generally over the long term, that has minimal impact on long-term returns. In the short term, it can. But we weren't seeking managers that hedge out currency. If that's something that the board desires for this portfolio, then that's a different, looking for something different.
That is not what I'm implying,
Okay.
but there should be some expertise when you are investing internationally, not to take account of what the currency is doing is just, I think, ridiculous, because you're exposing yourself to foreign currencies. And when you look at the attribution analysis here, I mean, the numbers show it. I mean, they're a decent manager. I'm just saying that if we're going to make a change and we're going to make an allocation, I think we can do better. That's my opinion. I mean, even passively, we can do better.
What is their peer ranking?
The peer ranking, I don't think we have that, Mill. I mean, you can see we had their net of fee performance over time,
So I
certainly.
think when we looked at them and Silchester at the same time, you did identify the peer ranking.
We did, yeah, I just don't know if I have it here today. We can certainly follow up with.
Okay, so we were looking at Silchester and Causeway. As Shariq indicated, are there others that we should be looking at? Because how do we compare if we don't look at what else is out there?
Exactly. Why don't we have 10 choices?
Yeah.
I mean, we should put them up.
Well,
And
we had,
even on the
before
passive,
before you joined the board, we did have a number of choices. And we brought it down, I brought it down to those two, and then I finally went with Silchester because of prior experience with Silchester,
Mhm.
going dating back to 2005. So most of the people I knew in Silchester gone,
Mhm.
long since.
Yeah,
So we have looked at more than
Okay.
two firms.
Yeah, I liked Causeway. They, you know, I like the way that it complements what we already have. I don't know if there's something better out there, because if we looked at it, it was either when I was really new on the board
Hmm.
or before that.
so when Jody, when you're mixing value and growth and
Yeah.
stuff, you're gonna see that anyway.
Right.
So what you're saying is correct, but that's not the only way to achieve that, so.
With 137 employees, where does Causeway rank in terms of size? Is that a tiny company, a mid-sized company?
Mid-size, there's larger ones, larger firms, there's smaller firms. More important for us, really is the portfolio management team, the size of that team, right? Because there are a lot of firms that are multinational firms that have many different resources, but they also cover many different areas.
And a lot of different products.
Right, exactly.
Sure.
And we want to keep our
Silchester,
diversity.
Silchester by comparison, what is the staff level at Silchester?
I think it's pretty, similar. And I'd say WCM is significantly smaller. I mean, we're talking probably,
And WCM is located where?
California.
Oh, okay.
So I mean,
And
for us,
what
it's
are
actually
they-
the size of the company, but Jenny, do you want to get to your question? Because you might not yet recall the search,
Yeah.
but certainly there are hundreds of
Yeah.
managers that are out there, right?
Right,
And ACG's job is to know those managers and to
Okay.
have our favorite list and kind of et cetera.
What are the fees on Silchester and Causeway?
It's on page 7.
As I recall, at 50/50, we increase our manager expense ratio by 4 basis points. Is that correct?
Correct.
I apologize, but WCM,
Oh, I thought,
is it
I
growth?
Causeway was less.
It is growth.
Okay.
Causeway is less, but because of the break evens, Tony, of the asset size, it will
Because,
slightly
yeah.
go up.
I'm not very good at math. so-
No, it's,
But it's 4 basis points. You can't see 4 basis points, but nominally it's 4 basis points is what I think he's.
And does Causeway have a redemption fee also, like Silchester does?
All of these commingled fund vehicles are gonna have that.
Okay.
Well, I'm not advocating, I'm also mentioning that there's one reason that the bench, the best index versus the bench is if you ever need to rebalance, a rebalance individual costs you money. versus
Yeah.
index. And it translates to the dollar interest have that stuff.
Yes, I don't recall that.
What does our percentage translate to in dollar amount?
so with today, it translates to kind of what would be if we were to split this at 73 million. Now, we are adding.
Split 73 million, is that what you said?
No. So we currently have,
79 in
In
Silchester,
79 in Silchester.
so split, rounded to 40.
So
But
we'd
you're
be more
underway.
in the,
They're underway
But
because you're
remember-
adding to non-US equity.
Oh, that, yeah.
we are underway.
That's
So-
just the Silchester waiting, but we do have to add dollars there, yeah.
So you'd be taking some from emerging markets.
so you'd be talking about a blended fee of somewhere in the 80 bips area. Plus, is there any trading costs in terms, and any additional to that,
So that's inclusive of this, but this,
inclusive of what?
of this fee that's listed here. So
The
this is-
trading costs.
Yes.
There are no trading costs whatsoever on top of this. You sure?
Well, the trading cost is in the performance.
I understand. I'm just talking about the fees at this point.
Right, so the trading cost, well, it comes out of the performance, correct?
There is what Tony mentioned. All commingled, non-US equity commingled fund vehicles will charge a redemption and an entry fee to protect other investors in the fund. Typically, it's up to 50 basis points. That's a
Well-
one-time fee.
Not all SIA platforms do that. Your platform may, but
We
not.
don't have a platform. We
No, I'm
have no
just saying, not
platform
all,
whatsoever.
in terms of, separately managed accounts, not all of them
And this
have
would not
it.
be a
And
separately
Not
managed account.
separately managed, that's a problem.
It's commingled.
Yeah. And the separately managed account would be a challenge. The retirement system does not have global custody. And so the charges for global custody, that would erode and that would cost you even more with your custodian. So this,
So maybe we are looking at 90 bips, 95 bips here.
Well, no, it'd be lower streak because, so the numbers we ran here on page 7, so it's based off of a total assets of 73 million. But again, if we've increased our target to develop DM, so it actually, this would be about go from 73 million to about 112 based on April 30th values. So it'd be more so about 65 million per manager. So we can kind of run the math real quick, but it would be
Well, again,
less than the
The numbers
78.
that you showed before, or the combination of the two, 50/50, would increase our expense ratio by 30 basis points.
Right, I guess what I'm saying now is if we bring this up to target, not just using current Silchester dollars, but add more to it, it might decrease that. So we might be increasing totally.
you're
a couple
going to
basis
hit
points.
break points because there's more
So-
dollars.
So just for the record, we could save 50 to 60 bips going passive, that you're
For
talking about
sure.
arguments to go passive, easy.
And fees.
We would have a much bigger bench in terms of, like you could do Franklin Templeton, big name internationally, or 100 other players, Vanguard.
Franklin
They would
Templeton.
have a much better team on ground, whether it's in Asia, whether it's in Europe, whether it's in London, whether it's in Singapore. They'll have teams on ground, they'll have,
Well, the
that's my
passive players
2
aren't
cents.
utilizing teams on the ground. They're just mirroring the index. And they might have offices in those locations, but they're not doing fundamental research on companies.
I don't know if I agree with that, but,
They're mirroring the index.
well, not all funds are.
I thought you said passive.
Isn't that what passive means?
Well, yes, but there are some that would do a more value-added tweak to that, so there would be some research, but yes, majority of it would be passive to the index, not getting away from it totally, so you don't have any surprises that way, so you don't find that, oh, we were suddenly all in banking, or
Don't
all
we-
in technology, or all in whatever, but within that,
Kind of a relaxed passive.
yeah.
You don't want active share in a passive vehicle. In other words. That's not why you're buying. Other questions or comments? Is the board ready to vote, or would the board prefer to postpone the decision pending further information on X, Y, or Z?
I don't feel comfortable voting yet.
No, I don't either.
The one thing that you all just mentioned that I hadn't been thinking about yet, I don't think it's significant, is the fact that we are increasing the international allocation as well. So we're adding about, I'm just doing a little, I'm not very good at math, but that's about a $50 million increase to the international allocation. If, how would that get split today if we added no new managers? Is it just pro rata across, so Silchester, WCM?
Yeah, they get the bulk of it, right? So Silchester and WCM are our two large cap development managers. That's the area we increase in our target the most. So we would try to pro rata get that raised up, which would be, it would be now be over 100 million with each manager.
So,
And some would be coming from emerging markets
oh, yeah.
because you're overweight, so you lowered your emerging market
Yeah,
target.
so
Coming
really,
back from real
Silchester
estate
and
too.
WCM are really gonna be the.
I figured you don't have that with you. You don't have that allocation. We went through this at the last meeting.
I do, so tell you what, guys, flip back to our A staff. You can
Page
just look at-
107.
You can just, yeah, 107, you can just look at kind of where we currently are.
So one of the things that'll happen, I'm only just sharing an observation. I don't have a position on this and I don't even have an agenda. I'm just kind of thinking a little bit. Is that post that reallocation, if no new managers are added, both Silchester and WCN would actually have, they'd be larger than 10% positions in the total fund. And I don't know how to think about that. That just feels like that's a large position with active managers. I know Rumline's higher, but they're passive. It doesn't
Right.
concern me. And I just wonder about the merit of these active managers could literally make one or two bad decisions and it could really affect performance. And should we be thinking just it, no matter what vehicle we choose, but just diversifying managers down so that they're not kind of above 10% positions? Is that just sensible no matter what, kind of given this rate? So I don't know if you have a thought or observation around that. It's just-
I think in our minds, as we think about this 10%, it is this kind of, nothing set in stone, but it is this line, 10% of our portfolio with any one investment that, obviously you want to be cognizant, right? Because that is certainly a lot of exposure.
Yeah.
So to go that way would certainly have to be managers we're very comfortable with, that we diligence and certainly stay on top of. So there's not in our mind a have to dwindle it down, but given that we're having this conversation and also bringing up international developed, this whole complementary idea, we thought certainly, Corey made some sense.
Just one more question, just purely from mechanics. No, forget the manager's active passive, but just when we raise cash to satisfy benefit payments, we typically are trimming managers or maybe just
Yeah.
how hard is it to trim international managers that have this redemption fee to raise capital to pay
Well,
back?
if it's a small dollar amount, 2 to 3 million, you're not paying the redemption fee.
They'll just
Yeah.
offset that.
Yes, it's when it's a large, full redemption or a significant one. And
And how about?
we haven't rebalanced from them for some time.
Yeah, I was just about.
But from not having nothing to do with a redemption fee,
Right.
it's more just liquidity.
Yeah.
Generally, international equity and emerging market funds are monthly.
Yeah.
And and it would be the last day of the month.
Yeah.
Or is the redemption date, and you don't get the money back until
Yeah.
sometime
Mid-month.
mid-month, the following month. So
Yeah.
for operating needs, it's a little bit, you got to plan ahead a little bit more.
So would that be reason enough to consider at least having something, like even if it's a 1 to 3% position in a passive vehicle, just that it helps, it's a source of liquidity, it helps with rebalancing, it's liquid, and we don't encounter these challenges.
So for our standpoint,
It hasn't been a problem thus far.
I know, but if we're increasing the dollar amounts to international, I'm just wondering if it could be and
But
would be
we're taking off from, generally speaking, from
other active.
commingled managers on the domestic side to commingled managers on the international side. It hasn't been a problem thus far. And you can always rob the fixed income, which is direct. You can always rob the fixed income portfolio for robs. Sorry, I didn't mean to use that word in your presence there. You can always borrow from the fixed income fund for a period of a couple of weeks and then replenish the.
Or you just plan ahead of.
Yeah. I'm
But
okay with
but
that
to
answer.
your
I
point,
just-
it would be more
I
like,
think-
it's, a passive option is more liquid
Yeah.
to rebalance.
And is that liquidity important enough that we should actually be thoughtful to have a 1 to 3% position as passive? That's all. Which isn't, it's almost like it's not even a pure investment decision. It's recognizing there's a lot of moving parts to running a pension plan other than just manager selection. That's all I'm thinking of.
It hasn't been an issue historically.
It's good.
And we do have, well, Remline is commingled trust as well, isn't it?
But it has daily.
Yeah, liquidity is passive.
Yeah.
Yeah. Okay.
Can I suggest something?
Yes.
Can we see a list of 12 managers? Maybe you break it up into two value, two growth, just like Causeway and Silchester, on 4 managers that are active managers within this. Maybe 4 managers that are the top passive managers. And then 4 ETF style value add, which are not completely mimicking the index. Excuse me. And we see all the numbers on them, whether it's 10-year return, 15-year return, the Sharpe ratios, all that stuff. Put it all in there and let's discuss it.
And value managers? Or just,
Well, I mean, that's what we're doing. We're mixing the two, right? So to get a little bit
well,
more.
right now, we're just talking about value.
So, I mean, we can visit the whole thing. Are we married to Silchester for some reason? I don't know.
No,
We can look at it.
Silchester's value, Causeway's value, but we hadn't been talking about WCM. So I think you're,
And the only reason I brought up WCM is it'll be above a 10% position after this reallocation. That's the only reason.
No, I think to have the agility and the flexibility of not having all these fees to go in and out, I think is a positive. I'd like to see what we are getting as a additional performance number by committing to that. So don't run the numbers to make them look good. I'm not saying you do that. I'm just saying take your 4 best, and whether it's active, whether it's passive,
but.
put it in there.
value and
Give
growth,
us your
that's
best
what I'm trying to do.
choices.
For
you know.
value and growth, or just,
I'd like to see some growth. I mean, if there's a reason we don't want to do that, that's fine. I mean,
I see no inherent reason unless we're concerned about the allocation to WCM after I'm not concerned about WCM, about the allocation, the percentage amount to WCM after we fully implement this 55-45 then. I see no reason to revisit that. We can revisit what we did when we selected Silchester. Those and I'm not sure who was on the board at that time. I know you were not. Matter of fact,
I
who
was.
it? Yeah, you were. What was the date, Silchester
Is
Day?
that 23? It made the
They were-
number 23.
they were funded in September of 2023, but I think that
Yeah.
discussion took place the first
Yeah.
couple months of 2023.
Yeah, it always does. Why don't we go back and revisit our large cap value, international large cap value options? Let's just revisit that. And let's see if there is a different approach that is compelling
Mhm.
than what we've discussed thus far.
So when you say you want to see
We can do
multiple,
that,
I mean,
we can do that at the next meeting.
Invesco has a multi-factor ETF that's more, over I mean, there are lots of them. You guys know them. You can just bring up what you think is the best, in your opinion. I mean, that's what you guys are there for.
Sure, so we can do that for what it's worth, and I think we're moving on at this point. We'll bring back, so there's a lot to go there. Let's take it out in small bites. We'll bring back the international value. We can look at some of these kind of factors Sharif you're talking about. For what it's worth, we'll bring back, page 14, we did put passive options down on the international side. And we'll bring that back as well.
We would be buying anything.
Excuse me, page 14.
Just of this, we did put in for this, just what some passive options are on the international side. Becky's brought it up there. So what benchmarks they cover, whether it's developed only or global, and what their
If
fees
you
are.
were to select one, what's it be?
Well,
If you were to recommend.
I mean, ultimately, I think the one that's kind of the cheapest, and we probably look at the State Street option or even kind of Vanguard.
I was thinking that's SGA, but it could be Vanguard.
Yeah, both of them.
What are we talking about?
Low fees. But again, we want to talk about if we want EM exposure in there, just developed, but as we all know, this is the bottom line, is passive is cheaper, and you get the benchmark exposure.
No, we don't want, we're not looking for an EM partner here. We're just looking for
Developed only,
a forceful,
no investment management.
hopefully successful
yeah.
allocation, strategic allocation, international large cap.
You're just buying that secure, which.
And I don't think we're getting everything that I hoped we would get with Silchester alone.
We'll look at it.
So I was just looking at possibly for a companion with Silchester.
But we will revisit and bring back again, Silchester and Causeway are parts of it, but we also have other kind of favorites on the value side.
On index funds. I'm just mentioning this,
Sorry.
Rick mentioned an ETF. I think your policy requires you to have an investment manager. And I know an exchange traded fund has a manager managing it, but it is a security that trades throughout the day. There is no investment management agreement or subscription agreement or anything.
Yeah, we'd have to.
Board would be
we just have to look
directing-
in whether or not the plan allows
Someone to
Please
purchase.
do
investment
that.
in an yeah,
Please do that, and what it takes to,
we'd have to amend the plan.
I understand.
Okay.
Okay, let's look at it one step at a time.
All right, let's come back with what we have at the next meeting. That's fine. I want everybody to feel that they've had a full opportunity to reevaluate what we're doing. Now, we're at 11 o'clock. It's important that we get to what Maggie has for us today. how critical is the information that you have? It's always important, but how critical, Jason, is the report itself right now?
I think we're talking about the decisions that you want to make. I don't know if there's anything critical about just an update from.
Okay.
No,
It's
the
our
only,
fault, it's our fault. What we did, we started the meeting at 9:30, and this is a 2-hour meeting, and we're cramming it in 90 minutes. And so next meeting will start at 9 o'clock.
Mhm.
And if we started at 9 o'clock this time, we'd be, I think, in pretty good shape.
Well, and that information is in here even if we don't review it.
yeah.
Okay.
The only thing I was just say, we did redline our investment policy statement to reflect the asset allocation target changes last month. We can quickly do that it does need approval, for you guys to be.
It needs approval only by this board.
Yeah.
It doesn't need anybody else's approval. Okay.
So if you want to do that, maybe quickly, just so tab 4,
Why don't we do so?
I can do it very quickly. And it's really,
Made the decision, we're just looking at the
you
line.
made the decision, and so it's tab 4, really pages 14 and 15. So what we're doing here is page 14 is the asset allocation, new target, strategic asset allocation that was approved by the board last month.
Oh.
Page 15 cleans up kind of managers that we have and their benchmarks. What I will point out, the bottom of page 14, so is adding here, updating the strategic policy index to match our target asset allocation.
Mhm.
Now, of note, in the past, if you kind of flip to page 129, the last page of this whole thing, sorry. On the left is our current policy index. And it was broken out, it just combined Russell 3000 was all US equity, ACWI US, all international. And so the proposed policy, what we say is, well, let's match our large cap versus small cap, developed versus developed, small cap, and emerging markets. So again, it matches, the Russell 3000 here matches, is for private equity, but it matches our target asset allocation, but it's just being a little bit more specific. So those are the proposed red line changes that again, would need this board's approval to be adopted.
And how much comes out of a large cap when we implement this?
So it was the target
On the
previously.
rebalance,
I think it's 15 million,
50 million?
I think.
Oh, from a dollar standpoint?
Yeah. So we had talked about parking that somewhere.
We're not gonna do anything.
Well, you're actually underweight the new large cap target.
Okay. Maybe more than that.
If you look at page 107, this reflects the new targets. Your new target to large cap is 24%, you're at 23. What's overweight is real estate and emerging markets.
Right. We have not implemented the change in terms of dollars as of
Haven't
yet.
done any,
The only thing we've done, we have put a redemption request for about 25 million from our real estate managers to bring that.
If we were gonna do that in any event, we may or may not be able to get it anytime soon.
Sharik, to answer, so to get back to your point, if you remember, so our previous target to large cap was 23.25%. It's now 24%, so it actually moved up. The reason it moved up, if you remember, because we dropped our target from real estate from 15 to 10. So that 15 came into equity, 75 bips went up to large cap, but then the rest was allocated elsewhere.
In other words, we have not tried to generate cash to reinvest in the international large cap or anything, because we were waiting to decide whether to remain just with Silchester or have a companion to Silchester.
But
So
also,
it's not a money cash issue at this particular point.
the other reason was that the SMID exposure was showing in large cap, as I remember. That is the reason why we backed off for that percentage in the end. And because we did not have another line here for SMID, and we said the SMID is rolled up into the large cap, as I remember the conversation.
well,
I don't, No, I mean, so again, it's by manager.
We have a SMID manager, but we don't have a line item here for SMID. It is showing up in large cap.
No, well, I'm not sure, follow what.
I thought that's what came out last time.
No, and so we have three large cap managers, right? Rumline being the largest, they're passive, Aristotle and Jennison, who are pretty large cap focused. They might, I mean, they have the ability to go a little bit mid cap, but most of those two managers pretty much large cap exclusively. And then Ernest and Granite are two small SMID managers.
Were you talking domestic or international?
I'm maybe getting a little,
That's true, my.
but I thought that one of these managers had a SMID exposure. We talked about that last time.
Domestic, they do, I think, but Granite is more of the
Well,
Smith.
Ernest is more,
Ernest
but I think
The
It
one
might be confusing
one
with
out
the
in
international
Atlanta.
conversation
Ernest
we
is in
had.
Atlanta, right?
But
Yeah, that's,
the policy index discussion, maybe that's what you're talking about? Where what Finney was just showing on page,
How much, the Rumline, how much SMID exposure do they have?
it's an S&P 500
No,
index.
it's just
So-
passive.
That's right. The Rumline is no. So there was something.
This might have been in the Silchester discussion when we were talking about that, because of the Silchester more of an all cap. Again, in our policy, they're in the international developed line, but they do have some certainly mid cap exposure in there.
Anyway, let's not dwell on it at this point, but we need to move on. So
all right, we do therefore need to vote on adoption of the new investment policy statement, which we discussed at the last couple of meetings, matter of fact, included at the last meeting. So now we have the language. So may I have a motion to approve at this point? Tony? I'll second that. Just so I can get my name in front. All right, good. Let's have a vote. All those in favor of adopting the new investment policy statement as written? Say aye. Any opposed? Well, that's done. Okay. Anything else? We got to spend some time with Maggie. So we're going to have to come back on the performance.
Yep.
thing with you.
Always changing.
Now, we have to first, of course, before we go into executive session, entertain any questions from our visitors. And Marion, I know you have one, please. Ms. Agag had correspondence that you wanted us to consider.
Pass around everyone. I believe we plan to discuss the proposed ordinance change today in closed session and vote on them at the June meeting. And I have a request in that regard. First, in the ordinance section 204095, please change the wording from the board shall from time to time study the need for post-retirement increases in benefits, taking into consideration changes in the cost of living since retirement. To the board shall on an annual basis study the need for post-retirement increases.
Mhm.
In 2003, the board requested the contract for our actuary Foster and Foster to be revised to include additional services that the board needed. One of those services was their annual COLA increase analysis. The contract amount was increased considerably. The ordinance was passed. Since the county is now paying for this service of getting an annual COLA recommendation, it only makes sense to put the requirement in the ordinance also. I've attached the.
By requirement, you're talking about shall as opposed to, shall annually as opposed to shall time to time. Okay, yeah,
So annually, you would review it, whether the answer is yes or no.
yes,
You review it for sure every year.
Carl.
Secondly, retirees Joyce and Dave and I have been advocating for several years for a formula to be used by the actuary when COLAs are granted. Most public jurisdictions in Missouri base their COLA on a formula similar to 0.8% of the increase in the consumer price index. Attached is a chart showing how Mosers, which is the state employee, loggers, which are local government retirees, and the city of St. Louis prepare their COLAs. We ask that you have the actuary use a similar formula rather than different amounts to different groups based on how long they've been retired. The CPI is a recognized measurement, and it's easier for retirees to understand. It would be helpful to put this in the ordinance also. Thank you.
Thank you, Mary. Scott, you wanted to say a few words?
I sent you guys some information. I asked for feedback from the board, but I always get feedback from ACG. The board is practically all new. It's very interesting, this whole Silchester, because I would like the board to look at the 2022 annual statement. There were 4 money managers in that year who had anywhere for a decade, this is a decade, annually, their below par was, Silchester was 0.83%. That's why they changed it. But did they change it to the passive index that they lost to? No, they chose another active one. So it's crazy that this ideology that active is the only way. And if it were, I want you to turn to page, Mr. Troy and Mr. Hulo sent you that big pack of stuff. Turn to page 18 if you would, please. And that second box down, they are comparing, their comparison is to similar pension funds. And we'll look at the 1 year, they were the 92nd percentile, 89th percentile for 3 years.
I'm sorry, which page are you on?
Page 18,
Of which book?
the one that handed out by ACG.
Today's.
Yes,
Oh, I know what you're talking about. Yeah.
yes. If you look at that, they don't hit 50% until 10 years. And the Sharpe ratios are even worse because they're not living up to their Sharpe ratio for the risk that they're taking. And yet they say they're doing a good job. Drop down to the next rectangle, right in the middle, says for the 12-month period. I have given the board, I have given the council information about the national defined benefit pension plans across the country, all sizes. They provide 64% average on, they get it from the investment fund, not from the county taxpayers. So we are at 33%. This is their figures. I mean, they're honest. They put it out here, but it just flows over the board and we never do a damn thing about it. So I appreciate you doing your job. Thank you.
Thank you. Any other visitors, comments? No. Okay, with that, I'd like to ask for us to go into closed session, and so therefore we have to
You
make.
make a motion to go into
Motion to
closed session,
close
and I will roll call vote.
I'll make the motion to go into closed session.
Second. All in favor?
Roll call,
All in favor?
roll call.
Come.
Each individual has to be asked.
Becky, you want to take the roll?
Take the roll, take the roll, just take the roll. I'll tell you what the
I
motion
made
is.
the motion.
Thank you.
Closed session.
Thank you. Have been, Paul Hamble,
Yes.
Tariq Mansuri,
Here.
Jody Patterson,
Yes.
Captain Aaron Schaefer,
Yes.
Tony Waskowitz,
Yes.
Milton Wilkins.
Yes. Okay, we are now officially in closed session.
No, wait.
See with me too.
Well, I was going to suggest Paul doesn't need to be in, I don't think Paul.
Yep.
Paul doesn't have, Paul, you don't have mortality tables yet, do you?
Yeah, this was sort of the purpose of me being here, Milt, was
Okay.
this closed session.
Unfortunately, we don't have the data.
Is everybody on the screen doing a closed session?
Not everybody on the screen. Paul is going to participate. Matt can if he's there.
Yeah.
Paul can participate.
Okay. Everybody that's virtual that's gonna be going to closed session, you're gonna get a pop-up, just hit yes or no, and you'll be moved to the closed session. I will move up in now.
Is Matt still
You
on?
want Matt Lipsey and Paul Bauer.
Yes,
That's it.
the only other person that's gonna be in there is gonna be us and
Matt and Paul. Okay. to regular session.
Back in regular session and non-regular. Thank you guys.
There being no further business to conduct, I have a motion to adjourn the meeting.
So moved.
Second.
All those
Sharif
in
and
favor?
Paul. Aye.
Okay, good. You're gonna look and see if we, if the date that we have for the next meeting is the only practical.
It's rounded practical.
It is